Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can follow me on Twitter and talk to me on Patreon. After another record quarter for earnings, we did see the stock shoot up briefly and to crash back down. Obviously, the main reason for the latest Tesla crash now has been Elon selling off more shares. Elon's rumored to have sold off a further $8.5 billion of Tesla stock to finance his purchase of Twitter, which has resulted in crashing the stock price over 10% just in a few days. Elon does say, however, that he appears to have stopped selling, but a lot of investors are not happy, and some have now even been called on margin. A lot of these investors are quoting what Elon initially told everyone, how Elon used to claim, "Just as my money was the first in, it will be the last out." Anyway, now Elon's sold Tesla stock, it will leave him with enough cash to take his total share of Twitter to around 25%. Elon does not need to purchase 100% though, obviously. I assume he's going to use a leveraged buyout for about 50% of Twitter and maybe taking on some other investors too. Anyway, it looks like Elon has sorted Twitter and hopefully not at the cost of Tesla's stock price anymore. But we have to wonder, how much of Elon's time is Twitter now going to consume? And is this at the cost of Elon focusing more on Tesla? Elon said every minute he spends thinking about Tesla adds about $1 million onto the value of Tesla. Therefore, there will now likely be minutes Elon will use to think about Twitter too at the cost of Tesla. Or could this be thought of as the opposite? Elon is so confident in Tesla now, and the roadmap and all the people he's placed in there he knows can do a great job, that Elon can now move on to other things. In general, I'm referring to Elon feeling confident about the 4680 ramp. Presumably, if it wasn't going well, Elon wouldn't be buying Twitter and would be back to sleeping on the warehouse floor, which is what we expect from Elon when things aren't going well. Not him to be acquiring social media sites with shares he said he would never sell. Anyway, this sell-off has started a wave of decline now, along with people getting margin called, resulting in more sales, and you can bet the shorts are out in full force. And perhaps Gates even doubled down on his position against Tesla too. And even after Elon announcing that he stopped selling his Tesla shares, the stock still dropped the following day. And then we're also hearing the economy shrank in the first 3 months of this year. In economics, we have a definition of a recession: if growth in real GDP is negative for 2 consecutive quarters. Right, well, we're halfway there. The economy might enter a recession, although it's a really strange environment. We're still recovering from supply chains, and have a war on top of that. Yet we also have an insane money supply at the same time, which could spiral out of control with inflation. There are a lot of signs pointing to more inflation on the way. However, this may not affect Tesla's sales so badly. In fact, perhaps Tesla can demonstrate it's a company that can handle inflation. Tesla really don't make many vehicles yet, still not even half as many vehicles as Mercedes make. The quantity that Tesla produce is still relatively small, in that Tesla can't meet demand. Now, in a recession, we think that demand will dwindle somewhat, but Tesla has about a 12-month waiting list on some vehicles. All Tesla would need to do is make sure they have enough orders to get through the recession, which generally lasts about 18 months. So I think Tesla can still do well in a recession. The stock price will likely take a bit of a hit though. There also aren't many events around the corner to boost Tesla's stock price. We only really have the split, which may not be for some time, and a potential S&P ratings improvement. Of course, at any time Tesla could announce a new event, like a robotaxi reveal, a new battery, or a new master plan, which could always bolster the stock price. In other words, the stock could get bashed and beaten around for a while down at this price for some time, perhaps trading between $900 and $1,000, then even getting beaten down to $800 or $700 from time to time. Now, I've been warning people about this second quarter for some time, and potentially some of Q3 too, if things don't start to improve, by which I mainly mean 4680 production. These new factories will have some serious additional running costs, which won't be made up for until they get closer to volume production. My guess is the new locations will be having a negative effect on EPS until they can reach about 15,000 units a month, perhaps at around 22% gross margin per new factory, but that needs further modelling to get better accuracy. It will take some time for the new factories to hit these run rates, at best likely Q3, but possibly not until Q4. If Q3 isn't starting to show signs of growth, then the market might actually crucify Tesla for getting up to Q3 and still no volume production from the new facilities. But this year might be similar to last year. Everyone looking at the progress of these 2 new factories or complaining about the delays like last year. Meanwhile, I was making videos on how much China was ramping up, to levels far beyond what we were told. I thought the fact that the Model Y factory in Shanghai has over double the capacity that we were told was a bigger deal than Berlin being delayed for yet another 4 weeks because of some red tape. And I feel perhaps that this year could be the same. China will likely carry this year's progress again. However, Shanghai has faced so many setbacks already so early in this year and lost a lot of production time. It sounds like Shanghai is seriously chomping at the bit to show us just how insanely quick they can actually make cars in those factories, along with CATL working equally hard to provide Tesla China with the majority of their battery supply required. I believe CATL is still the bottleneck there, and that all Tesla is somewhat of a placeholder company to just consume all these batteries CATL can produce. The partnership between the world's largest battery manufacturer and the world's largest EV manufacturer is brilliant. CATL can just get on with making as many batteries as they possibly can, including scaling up with 2 new fabs this year. And Tesla has these incredible production lines that move so much faster than what we're being told. It might be this month, May, or perhaps June, when we discover just how fast China can really spit out these vehicles. This extra production will definitely be felt in the earnings, but is it enough to compensate for the losses from the other 2 factories? Well, I'd say unlikely. Shanghai would probably have to do an additional 70,000 units in Q2 to make up for the losses of the new factories, and Shanghai lost almost a whole month in order to achieve that, so it's not happening. However, Austin hasn't even started advertising the new Model Y for sale, so if they don't start delivering from Texas, then there won't be all the associated costs of running the factory in cost of goods sold. Anyway, China won't hit that run rate in Q2, but could pick up in Q3. Given that China delivered around 180,000 units in Q1, an additional 70,000 would take China to 250,000 for a quarter, or an annual run rate of 1 million. And I'm actually expecting China to hit that run rate in Q3 sometime. Therefore, the extra costs the 2 new factories are creating should be covered by the additional expansion in China. Meaning I think we expect to see a dip in EPS for Q2, but I would expect to be back where we were in Q1 for Q3. In fact, slightly improved even. But from there, we are at the mercy of 4680 ramping to have a potential blowout Q4. I'm definitely aiming to buy this dip, but I just want to make sure I catch it down the bottom in case it does drop much lower. Personally, I think anything under 900 is a good price to be buying the stock, but I want to try and catch it cheaper. I'm going to be waiting for a sub $800 price tag. Now, this isn't me saying I think it's going to go that low. I'm just trying to get it that low. It already got close too, down to about $820 the other day. I don't feel like the market sentiment is very optimistic right now. I mean, the almighty Amazon crashed 14% in a single day. In fact, opening up my stock app the other morning, after the market closed, I just had notifications saying Coinbase, Spotify, Roblox and Rivian have reached all-time lows, and Amazon is at its 52-week low. It's starting to look very much like there's blood in the streets. I have about 5 Leaps purchases I intend on buying, and will buy them slowly on this dip. But my feeling is this will likely not be the last dip we see this year, and it may not be the lowest we see the stock. I was saying a similar thing all last year, how there'll be a lull through the middle part of last year as China ramps up. Well, we'll see a similar thing this year as the Berlin and Austin factories ramp. Now, I can't predict the future. This is just the future I think is the most likely, and I'm betting money on this future happening. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.